You only need a few good stocks in your lifetime. I mean, how many times do you need a stock to go up tenfold to make a lot of money? Not a lot. Everyone has the brain power to make money in stocks. Not everyone has the stomach. If you are susceptible to selling everything in a panic, you ought to avoid stocks and mutual funds altogether. The stock market really isn't a gamble, as long as you pick good companies that you think will do well, and not just because of the stock price. Far more money has been lost by investors preparing for corrections, or trying to anticipate corrections, than has been lost in corrections themselves. During the gold rush, most would-be miners lost money, but people who sold them picks, shovels, tents and blue jeans, Levi Strauss made a nice profit. If you're prepared to invest in a company, then you ought to be able to explain why in simple language that a fifth grader could understand, and quickly enough so the fifth grader won't get bored. The simpler it is, the better I like it. The person that turns over the most rocks wins the game. And that's always been my philosophy. Everyone has the brain power to make money in stocks. Not everyone has the stomach. The real key to making money in stocks is not to get scared out of them. Often, there is no correlation between the success of a company's operations and the success of its stock over a few months, or even a few years. In the long term, there is a 100% correlation between the success of the company and the success of its stock. This disparity is the key to making money. It pays to be patient and to own successful companies. In the long run, it's not just how much money you make that will determine your future prosperity. It's how much of that money you put to work, by saving it and investing it. Spend at least as much time researching a stock as you would choosing a refrigerator. What makes stocks valuable in the long run isn't the market. It's the profitability of the shares in the companies you own. As corporate profits increase, corporations become more valuable and sooner or later, their shares will sell for a higher price. Your investor's edge is not something you get from Wall Street experts. It's something you already have. You can outperform the experts if you use your edge by investing in companies or industries you already understand. Stocks are a safe bet, but only if you stay invested long enough to ride out the corrections. It only takes a handful of big winners to make a lifetime of investing worthwhile. Equity mutual funds are the perfect solution for people who want to own stocks without doing their own research. A stock market decline is as routine as a January blizzard in Colorado. If you're prepared, it can't hurt you. A decline is a great opportunity to pick up the bargains left behind by investors who are fleeing the storm and panic. Never invest in a company without understanding its finances. The biggest losses in stocks come from companies with poor balance sheets. The basic story remains simple and never-ending. Stocks aren't lottery tickets. There's a company attached to every share. The person that turns over the most rocks wins the game. And that's always been my philosophy. Bargains are the holy grail of the true stock picker. The fact that 10 to 30% of our net worth is lost in a market sell-off is of little consequence. We see the latest correction not as a disaster, but as an opportunity to acquire more shares at low prices. This is how great fortunes are made over time. Although it's easy to forget sometimes, a share is not a lottery ticket, it's part ownership of a business. Know what you own, and know why you own it. As I look back on it now, it's obvious that studying history and philosophy was much better preparation for the stock market than, say, studying statistics. All you need for a lifetime of successful investing is a few big winners, and the pluses from those will overwhelm the minuses from the stocks that don't work out. If you spend more than 13 minutes analyzing economic and market forecasts, you've wasted 10 minutes. When management owns stock, then rewarding the shareholders becomes a first priority, whereas when management simply collects a paycheck, then increasing salaries becomes a first priority. There are substantial rewards for adopting a regular routine of investing, and following it no matter what, and additional rewards for buying more shares, when most investors are scared into selling. Go for a business that any idiot can run, because sooner or later, any idiot probably is going to run it.